Ladies, welcome. This is a new lecture and a new work, which we'll do today about the journal adjustment entries. About the journal adjustment entries. We have work about the journal adjustment entries. And what the meaning of journal adjustment entries? What do we mean by the journal adjustment entries? This is the most important part for us. So journal adjustment entries is what we will do regarding two things. We have expenses and we have revenues. We have revenues and we have expenses. In the revenues, we have prepaid revenues and we have also accrued revenues. The prepaid revenues or unearned revenues. And in the expenses, we have prepaid expenses and accrued expenses. So we can say that the revenues and expenses, we have from them two things, prepaid and accrued. Let me tell you something here. We will work on the 4 parts. On these 4 parts, I will give example, will be including all these 4 parts. Like the prepaid expenses, example for the prepaid expenses in the journal entries, example for the depreciation, example for the accrued expenses, and example for the unearned revenues. In this example, we will see what we will deal and how we will set our journal entries. The point is, based on the one of the accounting principles, that you cover the area with the journal entries, whether the monetary units had been shifted to you or no. So here you have to register or record the transactions based on the area or the time or the span of the range of time in between till the end of your financial year. Which always, for most of the companies, ended on December 31. So as example here, I will start with the depreciation directly. I will go directly with the prepaid expenses. Let us see this example here. And note that this company is ending its year, the fiscal year end, in December 31. So our final is always December 31. So as example, if a transaction is done in November 1, then it will stay all November and December. This is 2 months. So we will do our entries and adjust our entries based on this time or this duration. First of all, the prepaid expenses. Let's say here, like a ABC company purchases a 1-year insurance policy. You know that the insurance policy is always paid in advance. So as example, I pay today, that will cover about 1 year in advance. But when did they buy it? On June 1, 24. For how much? $1,800 cash. Look at this again. I would say, ABC company purchases a 1-year insurance policy, but they didn't buy it in the start of the year. Notice that they end the transactions always here on December 31. They finish all their transactions on December 31. Or the fiscal year is ended on December 31. So here from June 1 till December 31. So this my work now is to do what? My work is to go to my calculations for this part, that the 1,800 for the whole year, And that started in June 1, as mentioned. But I have to see this. How much it is from June 1 into December 31 till December 31. I want to see how far this period will be till December. Let's go here till December 31. So how many months I spend here? June, all June, like we see here in the example. Let's go back to the example and see. The example is saying that ABC company purchased a 1-year insurance policy from June 1 until June 1, from June 1 till December 31. This is for $1,800. Perfect. So here, my dears, I have to count from June 1 to December 31. That means all June, and July, June, July, all July, all August, all September, all October, all November, and all December. So here, 1, 2, 3, 4, 5, 6, 7 months. We have 7 months for this transaction because it starts on June 1 and it will end in December 31, like I said here. So what I will do then, look at me here. Now what we will do here, we are in the first thing, which is the prepaid expenses. I will go, first of all, I have to do to prepare my own entries. So first I have to calculate the adjustments. How to calculate the adjustments here? You said that these are 7 months. The period from June 1 until December 31 is 7 months. So here, like we calculated here, we said we have 7 months from 1, 2, 3, 4, 5, 6, 7 months. So what we will do here now, we want to see what is deserved for this time from June 1 to December 31. This is what is basic for the year. And the rest will be prepaid. And the rest will be prepaid, means it will help in the next year. So I have all $1,800, all the insurance. Like we see here, all the amount of the insurance is $1,800. Yes. But what is allocated for the year? The year will not benefit from all this. We started this contract on June. So from June to December, like we said. So a portion of this will go here, and portion of this 1,800 will be used in the next year. So now I just want to isolate them, to split what I will use this year from what I will use in the next year. So actually, I will multiply the 1,800 times 7 months divided by 12. 12 because the year is 12 months. 7 divided by 12. That will give me $1,050. That will give me $1,050. $1,050, I will set the journal because this is what for the year, what goes for this year. Because my fiscal year, or what goes in between June and December, this $1,050 goes in between June 1 here, like here. It goes in between June 1 and December 31, between June 1 and December 31. So here, I will see 1,050 will set the journal entries. How the journal entries will be? Then I will go to the journal entries like every time. Every time in the adjustments of question of the adjustment entries adjustments, what we do, first of all, we split what is belong to the year, then what is not belong to the year. We have to disconnect them or separate them, separate between what is related to the year and what is not related to this year. Second thing, we put this in the journal entries. Of course, the whole contract must be registered, like recorded, the whole transaction. So the transaction is how much goes here. Like you see here, the transaction is for $1,800. The whole transaction is $1,800. So I start my journal entries here. I will start my journal entries here from prepaid expenses into cash. Why? Because cash is less with 1,000, with the whole amount. like, you know, how to do the journal entries. I showed you how to do it. You would make a column, 4 columns, like this, a table of 4 columns. And in the first column, the date, you write the date. This is the explanation, which including the parties of the debit and the parties of the credit. Then the amount debited, and here the amount credited. So here, the first thing is the prepaid expenses into cash. Yes, because I bought in cash. I bought this insurance money in cash was $1,800. So I will say from prepaid expenses into cash with the amount $1,800. Okay, cool. That's fine. Okay, next part, I will do what is belong to that year. What is belong to that year? We said here, let me remind you quickly. We said what is belong to this year, or what we have to put in our own records in the journal entries is what's belong to this year. So what's belong to this year is the whole 1,800 multiplied by 7 months divided by 12. This is only devoted or special for this year from June 1 till December 31. Then I will put it in the journal entry. So I did actually 2 transactions here. The first transaction is for the 1,800, the total amount of money. The total amount of money here, the 1,800. Then I will go now for the 1,050, which is belong to this year. So I will say what? From insurance expenses into prepaid insurance. This is how I will put the transaction. Insurance expenses, yes. Why? Because insurance expenses is what I paid for. I paid for the insurance expenses. Into prepaid insurance. Prepaid insurance because there is the whole amount here was 1,800 prepaid insurance. So I have to cut 1,050 from them. So what was debited, now I came to put it as a credit. So that means that it will be 1,800 minus 1,050. Again, prepaid expenses was debit here in the first transaction for the overall money, the overall amount. But here, the prepaid insurance will be credited with 1,050 due to, because it's belonged to this year. Okay, so that I split 1,050 out of 1,800. I split the 1,050, which is belonged to this year, then the 1,800, which is the whole amount. Okay, so again, those are the journal entries in case of the prepaid insurance, which is prepaid expenses. The prepaid insurance is a prepaid expenses. Again, I say the whole contract was $1,800. The whole contract is $1,800. And this is the $1,800, the whole contract, but the whole contract is from June 1, 2024 until June 1, 2025. But I don't want this. I'm now in 2024. I'm in 2024. So I'm registering for 2024. So what is the portion of the 1,800, which is belongs to 2024? That's what I'm doing. So here I have to separate or split what I have to pay in 24 and what we pay in 25. But what we will do with the 24? The 24, we will put them in journal entries because this is belong to the year. We have to put them because we said any transaction happened through the year, we do it with the amount which is physically happened through this year. So here I'll say 1,800 multiplied by 7 divided by 12. I'm repeating again. This will be 1,050. The 1,050, we will go to the journal entries. Actually, we do 2 journal entries. We do 2 journal entries. We actually do the first journal entry with 1,050. We do 2 with 1,800 from prepaid expenses into cash with the whole amount, Then from insurance expenses to prepaid insurance with the amount which is belong to the year, which is from June 1 until December 30. This is the first transactions, 2 transactions actually, which is belong to the prepaid insurance. Second thing, the second type of journal entries is the depreciation. Second type of journal of the adjustments, entry adjustments, is the depreciation. What about the depreciation? Here we said a company purchased a vehicle of August 31. Look at this. So I'm calculating from August 31 until December 31. I will calculate from August 31 until December 31. The price of this vehicle is $12,000 in cash. So cash means that I paid in cash. I didn't pay with account payable. I didn't pay with notes payable. I didn't sign a note, nothing. The vehicle is expected to live for 10 years, but we have this before. Guys, you remember when we say straight line method to calculate the depreciation. So here I will calculate the first thing I will do is calculating the depreciation here. So I will do what? I have the companies using straight line methods of depreciation. You know, there are many types of depreciation: straight line method, double dislining method, some of the years digit method. We have many ways to calculate the depreciation. But my point is I'm using straight line method. So I will go here, guys. I will go here on the depreciation part, and I would say the whole car price is 12,000 minus the scrap value. This is how I just remind you, because we had it before, but I will remind you to calculate the annual depreciation. To calculate your annual depreciation, to calculate this depreciation, we said the first thing is you would say the price of. So the price was 12,000. The price minus the scrap value. The scrap value is 0. How did I know? From the exercise itself. Because he told me in the exercise here, a purchase was purchased on August 31 for 12,000. The vehicle is expected to live useful life 10 years, after which time it will have no residual value. So the scrap or residual value, this is the residual value, is 0. So it's scrap or residual value. So here, scrap or residual value. Residual is the same meaning. Scrap or residual value is the same meaning. So price minus scrap divided by years of useful life. So here it is 12,000 minus 0 divided by number of useful life is 10 years. So that means this car is going to be deteriorated or lose $1,200 of its value each year. This is the meaning of this. So this car will have its price will go down 1,200 down less every year. This is the meaning of the annual depreciation. How far the value of the assets go down every year. So this is 1,200 per year. Then I will have to set the journal entries for this account, for this transaction. Because what's belong to the year is 1,200. But wait, we are recording the period which happened in the transaction. We are recording the period in which the transaction happened. But here, the transaction happened is not for the whole year. We bought this on August 31. We have to calculate until December 31. Because the 1,200 for 12 months. But we bought the car in August 31, which means almost September 1. So that means that in this year, we shouldn't calculate for 12 months, which is 1,200. No, we have to calculate only for the period between August 31, when we bought or when we purchased the car, until the end of fiscal year, which is December 31. So here I have September, October, November, December. We have 4 months. So the depreciation, the first year, which I got the car in, it will be 1,200 multiplied by 4 months divided by 12. This is $400. But wait a minute. This is what is belong to the year. We'll go now and record the transactions. We have to do our own journal entries here. Again, copy. Now we'll put it here. Now we'll take it, drag it like this. And I will say the same sentence, which we said here. Set your journal entries for the period, because you do your journal entries to the period. Set the journal entries. Here we go. Copy, and here I will put it. Set your journal entries. We have actually two transactions. The first transaction is the price of the car. Second transaction is the entry adjustment transaction. Or here we go. So firstly, the car, we bought it with 12,000 from car into cash with the $12,000 from car into cash. Then secondly, we have to do with the $400, which is belonged to the year, 4 months, because we said 1,200 for the year. That means $100 every month. So I have 4 months only in this year, simply because I bought this asset on this August 31. I bought the asset, and I'm calculating from August 31 until December 31. So I have here September, October, November, and December. We have 4 months here. We have to finish this within 4 months, or what is the deserved depreciation for the 4 months only. Cool, guys. Cool. That's very nice. Then we do the transactions of the depreciation from the car into cash, because we paid 12,000. This is the selling of the car, or buying a car in cash. Then here from the second or the journal entry for the adjustments. This is the adjustment journal entry from depreciation expenses into accumulated depreciation, from depreciation expenses to accumulated depreciation. And this is the second journal entry. From depreciation expenses until accumulated depreciation. And we do it by this way. Okay, guys? So these are, but what about the rest? 12,000, and this is $400 for the year. The rest will go to the balance sheet. Let me show you something. Here, I bought the car for 12,000 minus the 400 watches which belong to this year. Then my accumulated depreciation is $400 here, because it's the start. Then the net value of the car will be 11,600. That will be shown up in the balance sheet like I showed you, but not in my journal entries here. The 11,600 not to be shown up here, not to be shown up here. The 11,600 should be shown up in the 11,600, this amount should be shown up in the balance sheet, but not here. So this is the second transaction. We talk now about two things. We talk about prepaid insurance or prepaid expenses. And one example of the prepaid expenses is the insurance. And the second thing is the depreciation. Third, we call it accrued expenses. Accrued expenses, or the interests. The accrued expenses or the interests. Please pay attention here, because this is very important. The accrued expenses. On May 1, again, we will calculate. If I pay for May 1 for 1 year or whatever, I don't care about the 1 year. I care only about the part of the year from the date of the transaction started till December 31. Till December 31. That's what I care about. So here, first of all, I will say here, accrued expenses on May 1, 2024, ABC company borrows 10,000. Here we go for borrowing. Borrowing means that you get cash. So the cash will be debit. The cash will be debit from the bank and signs a note payable. Perfect. Signs a note payable. That's fine. When I say signs a note payable, then I will close it in the notes payable. So the first entry here will be for the 10,000, like I will do here. My first entry will be for the 10,000. Here it is. Because I said sign the note, So I will close the 10,000 in the notes payable. As long as I said sign note, then it will be closed in the notes payable. So I'll say cash from cash into notes payable. Okay, guys, from cash into notes payable. Fine. Let us go to complete the transaction. The transaction happened like this. On May 1, 2024, ABC Company borrows $10,000 from the bank and signs a note payable. The debt carries annual interest of 6%. So I have the interest 6%. If I didn't pay, the annual interest is 6%, means like 0.5% each month. So, and the repayed is repaid in full. It must be repaid in full. But wait a minute. Repaid in full with interest on July 1. So it has to be paid on July 1. May. And here, he repaid in full with the interest on July 1. Okay, so here, if it is for annual interest, means for 12 months. We'll check out how many months more now than 12 months. Let us go and see how we did this. So here, first of all, we will calculate. We'll do our adjustment operations or the adjustment entries. The first of all, we'll see how much is the interest. Interest is the principal, which is 10,000, multiplied by the interest rate 6%, because he said 6% interest rate. So this will be $600 every year. But wait. That's more than 1 year, guys. That's more than 1 year. Okay. But for the moment, we calculate the accrued for the rest of the first year. So from the first year, from May 1 to December 31. So now May, June, July, August, September, October, November, December. That is 8 months. That will be 8 months. Because we started the transaction, look at this here again. Accrued expenses is paid on July 1 year from the bank and signs the note payable. The debt carriers annual interest of 6% and is repaid in full with interest of. So here, like you see, on May, I want to calculate from May to the end of the year. We calculated it is 8 months. We calculated it was 8 months. Then here, I will say, if I pay 600 for the whole year, how did I know? Because the interest will, for annual interest, the annual 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 interest for each year is $10,000 multiplied by the 6% will give me $600 a year. Cool. But I will not pay for the first year for the whole year. I will not pay for the first year for the whole year, simply because only I will pay for 8 months. Why? Because I did the transaction on May 1, and I'm calculating from May 1 into December 31. I'm calculating this period from May 1 into December 31. So I would say $600 multiplied by 8 divided by 12. That will give me how much, guys? Will give me $400. This 400 is like what we said. What is belong to the year will go to the journal entry. What is belong to the year will go to the journal entry. For that reason, I will put it like this to the journal entry. And I will go, let me go and register how we will do this in the journal entry. This is the first two is for the first operation, which is prepaid expenses. The second two for the depreciation. And now we will go the third two for the notes payable. Here we'll say from cash, because we signed a note. Then we will put cash from cash 10,000 into notes payable 10,000, because we said we borrowed cash and signed the note. That's why we close it in the notes payable. That's why we close it in the notes payable. Like here, I will show you again. In the transaction here, we said borrows 10,000 from the bank and signs a notes payable. So that for that reason, the whole amount will make a registration or record the whole amount from cash 10,000 into notes payable with the amount of 10,000. Okay. Then what is belonging to the year we calculated, it's $400. How we did this again, I will show you again. we said the annual interest is 600, but this is for the whole year. But we said we have only 8 months between May 1, when we borrow the money, until December 31. They are 8 months. So I would say the portion of the year, or the quotas of the year, will be $600 multiplied by 8 divided by 12. That will give me $400. So this to the journal entry. I will go and do a transaction with this 400 here right now. $400 from the interest expenses into interest payable. So I close the interest expenses, because before this is interest expenses. These are interest expenses. I will close it in interest payable, which is $400. Interest payable. We close it in the account, interest payable. Okay. Also, let us say one thing more, because this is not done here. This is not done here. This is not done here. The transaction is completed also, and including 2 more points. When we go to see, this guy started in May, and he paid on July the next year. So when we come to see now, this is not only a matter of 1 year, it's more than 1 year, because from May to May, this is 1 year. Then June and July, there is another 2 extra months. Let us see, how did we calculate it? Because the payment was done on July, like I said here, July 1, 25, then there we have to calculate the interest of the periods that equals the $600 multiplied by 6 divided by 12. 6 months. Which is the interest that will equal $300. We have a deferred payment. We have a deferred payment. Okay, guys. So here, that will equal $300 as well. That will equal $300 as well. So here, now the interest will equal, the total interest will equal the $400 plus the $300 plus the principal of the money, which is $10,000. That is why it will equal 10,000 plus 400 plus 300. So he will pay the 10,000 plus the 400, which is interest of the first period, and 300 for the interest of starting from January, February, March, April, May, June. Here it is, because you will start on July 1. So here he has 6 months for the next period. Let's see like this. The payment was done in July 1. So here, for next year, the payment is done on July 1. Look at this here. And the payment was done in July 1, 25. So now, let us calculate from December 31 to July 1. From December 31 to July 1. So this will include January, February, March, April, May, June, 6 months. For that reason, the new period, it will be 6 months divided by 12. That will give me $300. So he has to pay $400 for the principal itself. The principal is 10,000 plus $400 for the first time from when he bought these things into from May 1 to December 31. He will pay $400, like we said before. Then he has to pay also $300 for the period from December 31, 24 until July 1, 25. This is 24. Let me just to be clear for you guys, till July 1, 25. So let's see, we'll pay 6 months, 6 out of 12, that will be 300. So the whole amount which he has to pay now, the money which he borrowed, plus the interest of the first portion of the year, plus the interest of the second portion of the year. The first one is the 10,000. This is the portion of the interest he would pay plus the assets for the year 24. And this is the part of the year 25, the 6 months of the year 25. So all the amount will be 10,700. That will go also to the journal entries, like we said here. We will put it in the journal entries. So first of all here, we will do also the same, what we did for the first 4 months, 6 months, we will do again for the next period. So we'll say interest expenses into interest payable with $300. That means now I have 10,000 plus 400 plus 300. That means that all of them will equal 10,700. Okay, I paid them. So cash will be credit. I paid. So cash will be credit. And what will be debit is the origin of the amount, which I pay with the notes payable, and the $700, which are the 400 and the 300, because they both are interest payable. So the journal entry will be from notes payable and interest payable into cash with the amount of 10,700. That was for the third transaction. The fourth transaction is about unearned revenues. What do we mean by unearned revenues? Unearned revenues is the kind of revenues occur always when you take money for a service you did not do yet. You did not do that. You took the revenues in advance. As example, someone told you how much this will cost. You tell him to prepare this or to fix this or I will take $5,000. He told you, okay, take the $5,000 and do it. And when you do it, just let me know. In that case, this is, we call it unearned revenue. Unearned means that you get the money before you do the service. Unearned revenue, you get the money, or you get the boxes, or you get the dollars, or the rupees before you did the services. But this is very crucial, very important. Yes. Let us see how to do the journal entries transactions here for the unearned revenues. A client prepay, let's look at this, prepays. Prepays means he pay in advance. ABC company on November 1, 2024 for 5 months of consulting services. It's called consulting services from November through the end of March. So November, December, January, February, March. We have 5 months here. We have 5 months from November until March. The company pays 15,000. So 15,000 for the 5 months. That means I have to pay how much, guys? If I'm paying, let me write it for you here. If I'm paying now, the company paid 15,000 for 5 months. Then for 5 months. So I will divide by 5. That means that the company will paid 3,000 in advance for each month. $3,000 in advance for each month. They paid in advance $3,000 for each month, and that's for a period of 5 months. Okay. Very nice. Very, very nice. Then I have to calculate now to go for the prepaid expenses for this period. They have to go for the prepaid expenses for this period. Let us show it here. Go first and do the entries and the operations and the calculations. And so record the $15,000 and set the journal entries for the whole amount, which is $15,000. We'll go now to the journal entries and register the $15,000 here. From, we received cash, right? We received cash from unearned revenues. Unearned revenues means revenues which occur. I took the money and I didn't do any work yet. I took the money prior to performance. I didn't do anything. I didn't do work, but I took the money in advance. I took money in advance. So here we'll say from cash because the cash is increased. So it's from cash into unearned revenue. Unearned revenue. From cash to unearned revenue with the 15,000. Okay. This is the first journal entry. Second thing is what's belong to the year. What will be belong to the year? We have to calculate what is belong to the year. So here we said the 15,000 for 5 months. Then how much for each month? It will be 15,000 divided by 5. Then it will be $3,000 per month. We said the 15,000 for the period of time. Here it is, the period of time. Let me show you the period of time. The period of time from November 1 until March. November 1 until an end in March. So this is 5 months. So 15 divided by 5, that means $3,000 per month. 15,000 divided by 5, that means $3,000 per month. Cool. So we'll calculate what is belong to the year. So what is belong to the year is from November and December. Only November and December are belong to the year. November and December only or belong to the year. So 2 months. 2 months, each month 3,000. Then we will register $6,000 for the 2 months. Then I have to go and put set the journal entries for this 2 months. I have to put the journal entries for this 2 months. Here we go. First of all, I will register from cash the whole amount 15,000 into unearned revenue. From cash to unearned revenue with the 15,000. Then I will register what is belong to the rest of the year. So the rest of the year, November and December, only 2 months. So here unearned revenue into consulting revenue with the 6,000, which is for the 2 months. Here again, the 3,000 times 2 will equal 6,000. This is till the end of December, and I will put it on the journal entry. So I did 2 transactions. One transaction for the overall amount which I received as prepay, or the company paid for me 15,000 for consulting services. I didn't work with them yet, and they said this is for 5 months. Each month is 3,000. So I register record all the amount, which is $15,000 from cash into unearned revenue, was 15,000. Then the second one, from only with the 6,000 which belong to the year. The reason is that each month is 3,000, and we did this on November 1. So it will be till December 31. It is 2 months. So the 2 months will be 3,000 per month multiplied by 2. Here, multiplied by 2, that will give me 6,000. I have to put it also in the journal entry. So I will put the overall amount, like I did with all the transactions. Overall amount here is from cash to unearned revenues. The reason I said cash to unearned revenues because the cash increase was 15,000. They gave me the money and unearned revenue because I didn't do anything yet with the money which I took. I took the money before I do the service. I took the money before I do the service. So this is the 15,000. Then I will register again what is belong to these 2 months only. So unearned revenue, 6,000, into consulting services for the 2 months, which is November and December, 3,000 for each, time 2 months. That will give me $6,000 for the period from November 1 till December 31. From unearned revenue into the name of the service, which is consulting services, or consulting services revenue, or consulting revenue. That was quickly the 4 types of the major journal adjustments, the 4 types of the major journal journal entries adjustments, which like the prepaid expenses, the depreciation, and accrued expenses, and unearned revenues. And this was a simple example which make easy for you guys to know what to do. Like we said, the main thing is that we record what is belonged to the year. We record the whole transaction, of course, but then we record in the journal entries what is belonged to the rest of the year. Because if it is for a year, that's fine. But sometimes you do the transaction in the middle of the year, in the start of the year, before the end of the year. So you want to calculate the quotas of the year only, how much it is. Then you do journal entries for this part of the transaction. That's all I have for the moment. Shall see you on the next video.